This is the Japan market brief. Here is your Tokyo market close summary for April 15. Japan's market closed firmer on April 15, with Tokyo pushing back into the 58,000 range after hopes grew that the United States and Iran could restart talks. That helped lower the immediate sense of oil stress, and it gave Japanese equities another relief session. But the broader reading is still cautious. This looked more like a reduction in external fear than a full improvement in Japan's own domestic growth picture. The most important market driver today was relief on the geopolitical side. Japanese equities have been trading around oil, logistics, and currency pressure for days. So once investors believed the next step might be diplomacy instead of escalation, risk appetite improved quickly. That matters in Japan more than in some other markets because energy prices feed directly into so many areas of the economy. A softer oil narrative means less immediate strain on transport, petrochemicals, utilities, and consumer prices. It also gives the equity market room to focus on company stories instead of trading only macro fear. The yen also stayed relatively contained. There was no fresh FX shock, and that helped reduce one more layer of stress. When dollar-yen is stable enough, investors are more willing to rotate back into equities without treating every move as a currency event. Even so, this was not a fully convincing domestic growth rally. IMF growth concerns remained in the background, and the broader global picture still looked uneven. There were also continued reminders that Japan's domestic economy is not firing on all cylinders. One useful contrast came from the tourism data. March inbound visitors rose to a record for the month, showing that travel demand into Japan is still strong. But that does not automatically mean domestic consumption is equally healthy. The market still has to deal with a split economy, where inbound-related demand can look firm, while ordinary household demand stays more selective. There was also another reminder that the energy problem has not disappeared. The government extended the temporary easing of private oil stockpiling obligations by another month. That is not the action of a government that thinks the issue is fully behind it. It suggests the market was right to rally on relief, but not to assume the full risk has vanished. Today's stock to watch is Takashimaya. NHK reported that the department store operator plans to sell part of its non-core real estate and put more focus on strengthening its core retail business. The report also suggested that activist shareholder pressure was part of the backdrop. That makes Takashimaya highly relevant today because it connects several Japan themes at once. First, domestic demand remains soft enough that retailers cannot rely on a broad-based recovery. Second, inbound tourism is still supportive, especially for major urban department stores. Third, investors are increasingly rewarding companies that show clearer discipline around capital allocation. So Takashimaya is not just a department store story. It is a restructuring and rerating story. If investors respond positively, that tells us the market still wants company-specific change that can create value even while the macro backdrop remains fragile. This is why Takashimaya stands out more than a generic exporter today. Exporters still depend heavily on currency and global demand. Takashimaya offers something more internal: asset sales, sharper business focus, and a management response to shareholder pressure. That is a more distinctive signal on a day when the index itself was lifted mainly by relief. Going into the next session, there are three things worth watching. First, whether oil remains calmer. Second, whether dollar-yen avoids a fresh volatility spike. Third, whether restructuring stories like Takashimaya keep attracting interest over pure macro-sensitive names. If those three things hold, Tokyo can continue stabilizing. If not, today's rally may end up looking like another temporary relief move rather than the start of a more durable re-rating. That was your Japan market brief for April 15.